Okay, so you want to own a water utility. You buy a treatment plant, a reservoir, and thousands of kilometers of buried pipe. Every home needs your product. Customers cannot choose a competing pipe network. Demand returns every morning, and the bills keep arriving, whether the economy is booming or shrinking. It looks like the safest monopoly imaginable. That is the dream. The reality is that you do not really own a water selling machine. You own a regulated obligation to deliver a safe product at the correct pressure every hour of every day through infrastructure that may be older than the people operating it. You must invest before you know exactly how much regulators will let you recover. When a main breaks, a drought arrives, a contaminant is detected, or interest rates rise. The repair bill belongs to you immediately. The customer bill may not change for months or years. That is the strange economics of owning a water utility. The product is essential, the customer base is captive, and revenue is unusually stable. Yet the owner cannot freely set the price, reduce service when margins tighten, or close an unprofitable neighborhood. The same rules that make the business look protected also turn it into a capital-intensive promise that never switches off. A water utility begins with a source. That may be a river reservoir aquifer or bulk water contract with another system. Raw water moves through intake structures and pumps before entering a treatment plant, where operators remove sediment, microorganisms, metals, chemicals, and other contaminants. The finished water is stored, pressurized, and pushed into a distribution network. From there, smaller mains and service lines carry it to homes, factories, hospitals, schools, and fire hydrants. The visible product is water. The actual business is reliability. Customers are not paying only for the liters or gallons passing through a meter. They are paying for treatment capacity that must be ready before demand appears, pumps that maintain pressure during peak hours, laboratory testing that detects problems before people become sick, storage tanks that smooth out demand, backup generators that start during an outage, and crews that can reach a broken main at 3 in the morning. This is why a water bill can rise even when a household uses less water. Much of the system's cost does not disappear when consumption falls. A pipe costs the same to inspect whether it carries 10 million gallons or 8 million. The treatment plant still needs trained operators. Debt payments do not shrink during a wet summer. Regulators may encourage conservation, but conservation can reduce the volume on which part of the utility's revenue depends. Before any of that matters, you need permission to operate. Money alone is not enough. A private buyer may need approval from a state public utility commission, local government competition authority, environmental regulator, and sometimes voters or municipal officials. Water rights must be secure. The source must satisfy withdrawal limits. Treatment facilities need permits. Drinking water must meet health standards. Construction may require zoning approval, environmental review, land access, and easements across private property. Acquiring an existing system can be even more complicated. Regulators may ask whether the purchase benefits customers, whether the price is reasonable, whether the buyer has enough technical and financial capacity, and how much of the acquisition price can eventually be recovered through rates. A seller may want the highest possible price. The buyer may be willing to pay a premium for a protected service territory. The regulator, however, can decide that customers should not finance every dollar of that premium. This creates the first major distinction between owning an ordinary company and owning a regulated utility. In a normal acquisition, the buyer decides what the asset is worth and accepts the consequences. In a water utility, the purchase price and the value recognized for rate-setting purposes may be very different numbers. The entry price is also much larger than the treatment plant standing above ground. A complete system includes land, water rights, wells or intakes, chemical storage, pumping stations, laboratories, control systems, reservoirs, meters, fire flow capacity, customer service technology, vehicles, emergency equipment, and a vast network of buried assets. The most expensive part may be the part nobody sees. The United States Environmental Protection Agency estimates that drinking water systems need about $625 billion of infrastructure investment over 20 years. Roughly $423 billion of that need is associated with distribution and transmission, meaning pipelines, valves, and related equipment. Treatment needs account for another $107 billion, while storage and source projects add tens of billions more. Those figures reveal the central physical problem. A water utility can operate for decades while gradually consuming its own infrastructure. Pipes corrode underground. Valves become difficult to close. Pumps lose efficiency. Storage tanks require rehabilitation. Small leaks become larger leaks. And an old network may lose treated water before it ever reaches a paying customer. Buying a utility, therefore, means buying both the assets you can inspect and the maintenance history you cannot fully observe. A network with low bills may not be efficient. It may simply have postponed replacement. What looks like affordability today can become a capital crisis tomorrow. Most buyers cannot fund this entirely with equity, so debt becomes part of the model. That debt may be issued through utility subsidiaries, municipal bonds, bank facilities, or holding company structures. Long-lived assets can support long-term borrowing because pipes and treatment plants may remain useful for generations. Stable customer demand also makes lenders comfortable. The danger appears when stable demand is confused with guaranteed cash. Regulated utilities usually earn revenue through an approved rate structure. The owner files a rate case, presents operating costs and investment plans, and asks the regulator to authorize enough revenue to cover prudent expenses, depreciation, taxes, and a return on invested capital. The approved investment base is commonly called the rate base. In plain language, the regulator decides how much infrastructure investment should be recognized, how the utility should be financed, and what return is reasonable. That allowed return is not a guaranteed profit. It is an opportunity to earn a return if the utility controls costs, meets service standards, and operates within the approved framework. A real rate case shows how specific the process can become. In May 2025, the Iowa Utilities Commission approved an authorized rate base of about $262 million for Iowa American Water, an authorized return on equity of 9.6%, and a capital structure containing roughly 53% common equity and 47% long-term debt. That does not mean the company earns 9.6% of revenue. It does not mean the owner earns 9.6% of the purchase price. The allowed return applies to the equity portion of the approved rate base, while debt costs, operating expenses, depreciation, and other items are handled separately inside the revenue requirement. If the utility spends money that regulators consider unnecessary or poorly managed, some of that spending may not be recovered. The business therefore runs on a cycle. First, capital is raised. Next, the utility builds or replaces infrastructure. After that, management documents the spending and asks for rate recovery. Regulators review the work, customers and public advocates challenge the request, and a final decision determines how much additional revenue can be collected. The time between spending and recovery is called regulatory lag. During that period, contractors expect payment, lenders charge interest, employees receive wages, and the new asset begins depreciating. The approved rate increase may arrive later than expected, be smaller than requested, or include conditions the owner did not anticipate. This is the central trap of owning a water utility. Invest first, recover later. The revenue stack looks simple until each layer is examined. Residential customers usually pay a fixed service charge, plus a charge based on measured consumption. The fixed portion helps support costs that exist regardless of usage. The volumetric portion links the bill to the amount of water delivered and encourages conservation. Commercial and industrial customers form a second layer. Restaurants, office buildings, factories, laundries, hospitals, and large campuses may consume far more water than a household. Their demand can improve system utilization, but one major customer can also possess bargaining power. If a factory closes, relocates, or installs recycling equipment, the utility may lose a large block of sales while most network costs remain. Wholesale contracts create another stream. A utility may treat water for a neighboring town, sell bulk supply to a smaller system, or operate facilities under a long-term municipal agreement. These contracts can stabilize revenue, although they may contain price formulas, minimum volumes, renewal risks, and performance obligations. Fire protection charges, meter fees, connection charges, and developer contributions add further layers. New housing developments may pay to connect to the network or fund part of an extension. Some utilities also own wastewater systems, which add sewer collection and treatment revenue, but introduce a second network of pumps, pipes, environmental permits, and capital requirements. The owner never keeps the full bill. Labor is one of the largest continuing costs because treatment operators, engineers, laboratory technicians, construction crews, call center employees, cybersecurity specialists, and emergency teams cannot be replaced by a simple billing system. Electricity powers pumps and treatment equipment. Chemicals must be purchased and stored. Water may need to be bought from another supplier. Laboratories test for compliance. Insurance protects against accidents and liabilities. Vehicles, meters, valves, software, and control systems require maintenance. Then comes depreciation, which spreads the accounting cost of long-lived infrastructure across many years. Depreciation is not the same as the cash needed to replace the asset. A pipe installed decades ago may cost far more to replace today than its original accounting value suggests. Excavation traffic management permits labor and surface restoration can make a short urban replacement extraordinarily expensive. Interest adds another layer. The utility may appear profitable before financing costs and weak afterward. Higher rates affect new borrowing, refinancing, and the calculation regulators use when deciding an appropriate return. If capital spending rises at the same time borrowing becomes more expensive, the owner can be squeezed from both directions. Taxes, compliance, pension obligations, customer assistance programs, and security complete the cost machine. None of these costs cares that the product falls from the sky for free. Raw water may be inexpensive. Safe, pressurized, continuously available water is not. At first, the monopoly still seems powerful. There is usually no second pipe network competing for each home. Customers cannot switch providers because they dislike the bill. Demand is essential. But the regulator stands between monopoly power and customer pricing. Public utility commissions can disallow costs, reduce requested returns, phase in increases, create performance penalties, or require customer protections. Public hearings expose the company's assumptions. Consumer advocates examine executive compensation, financing, operating efficiency, and capital plans. Political pressure intensifies when bills rise faster than household incomes. The customer may be captive, but the price is not controlled by the owner. Affordability becomes more than a public relations issue. If too many customers cannot pay collections, weakened assistance costs rise, and regulators may resist future increases. A utility that invests too little can create reliability and compliance failures. A utility that invests rapidly can produce bill shock. The owner must balance physical need, financial capacity, and public acceptance inside the same plan. The difficulty becomes clearer when a financially stressed utility is examined. Thames Water serves about 16 million customers across London and the surrounding region. It owns an essential network in one of the wealthiest and most densely populated service territories in Europe. From the outside, that should look like an almost perfect infrastructure asset. Its latest annual results for the 12 months ending March 2026 show why revenue alone does not describe the business. Thames Water reported underlying revenue of about £3.6 billion and underlying operating profit of roughly £1.3 billion. Underlying profit after tax was £204 million. Those numbers sound strong. During the same year, however, capital investment reached a record £2.68 billion. Net cash outflow before funding was approximately £1.13 billion. Gearing, a measure of debt relative to the regulated capital value, stood at 86.1%. The company reported about £1.04 billion of liquidity and paid no dividends. A business can therefore show operating profit, report positive profit after tax, and still require more funding to continue its investment program. Accounting earnings describe one layer. Capital spending, debt maturities, interest, and liquidity describe another. Thames Water's problem was not one broken pipe or one weak year. The structure had become vulnerable to a combination of high leverage, enormous investment needs, regulatory pressure, operational failures, and the difficulty of raising fresh capital on acceptable terms. In May 2025, Ofwat imposed penalties totaling £122.7 million following investigations into wastewater operations and dividend-related license breaches. The wastewater investigation concluded that the company had failed to operate, maintain, and upgrade assets adequately in important areas. Ofwat also issued an enforcement order requiring corrective action. The penalty itself was not large enough to explain the entire financial crisis. Its importance was what it revealed. A utility cannot treat regulation as a predictable formula while service quality deteriorates. The license includes obligations not merely protection from competition. Because the company was already managing limited liquidity during a refinancing process, Ofwat later agreed to a payment plan. 20% of the penalties was due in September 2025, with the remainder linked to a financial restructuring, an exit from special administration if that process occurred, or a 2030 backstop date. Think about the contradiction. The regulator imposed a penalty to protect customers and the environment, yet also had to consider whether immediate payment would weaken the company's ability to finance its statutory duties. The utility was too essential to stop, too indebted to operate comfortably, and too regulated to solve the problem simply by raising prices overnight. This is what failure looks like in essential infrastructure. The taps do not necessarily stop. Employees continue working. Revenue continues arriving. Instead, financial flexibility disappears. Lenders gain influence. Regulators tighten oversight. Shareholders face dilution or loss. New capital demands stronger protections. Every decision becomes a negotiation over who absorbs the cost of keeping the system alive. Now compare that with a utility that has made the regulated model work at scale. American Water is the largest publicly traded water and wastewater utility in the United States by operating revenue and population served. At the end of 2025, it employed about 7,000 people and provided services to approximately 14 million people across 24 states, including regulated operations and other contracts. Its 2025 results show a very different position. Operating revenue reached approximately $5.14 billion. Operating income was about $1.88 billion, and net income attributable to common shareholders was roughly $1.11 billion. The company invested about $3.2 billion during the year and completed 18 acquisitions across 7 states. The important point is not that American Water discovered a way to avoid capital spending. Its spending is enormous. The advantage comes from scale, geographic diversification, access to capital markets, operating experience, and a long process of obtaining regulatory recovery for investment. A larger system can spread specialized staff, technology, purchasing, engineering, and compliance capabilities across more customers. It can issue debt more efficiently than a tiny local utility. Acquisitions add customers and create opportunities to replace aging infrastructure, although each transaction still requires approval and integration. Its 2025 revenue growth was driven largely by authorized increases following completed rate cases and infrastructure proceedings. That sentence contains the business model. Capital is invested, regulators review the investment approved, revenue rises, and the rate base expands. Growth does not come mainly from persuading households to use more water. It comes from placing necessary, prudent infrastructure into service and earning an authorized return over time. Even this model is not automatic. American Water's operating costs, depreciation, and interest expense also increased as investment grew. More rate base can create more earnings potential, but it also creates a larger financing requirement. Success depends on keeping the capital recovery cycle moving, without allowing bill service failures or leverage to outrun regulatory support. To see how quickly the economics can change, imagine that you own a regional water utility serving about 100,000 customer connections. These numbers are illustrative, but they reflect the shape of a real regulated system. In a normal year, residential fixed charges and usage produce $78 million. Commercial and industrial customers contribute $20 million. Wholesale supply, fire protection, connection charges, and other regulated services add $14 million. Total revenue reaches $112 million. Cash operating costs consume $56 million. That includes labor power, chemicals purchased, water, routine maintenance, testing, customer service, and administration. Earnings before interest, taxes, depreciation, and amortization are therefore $56 million. This measure is commonly called EBITDA, and it shows operating performance before the cost of financing and long-lived assets. Depreciation removes $23 million, leaving $33 million of operating profit. Interest expense takes $17 million. Taxes and other items remove another $5 million. Net income is about $11 million. That appears comfortable until capital spending enters the picture. The utility spends $40 million replacing mains, upgrading treatment, installing meters, and expanding storage. Depreciation is added back because it was a non-cash accounting expense. So, net income plus depreciation provides approximately $34 million of internal cash. The capital program still exceeds that amount by $6 million before other working capital movements. The utility must finance the gap with new debt, new equity grants, developer funding, or existing cash. Reporting an accounting profit does not eliminate the need for outside capital. Now change one variable. The $112 million of expected revenue included a $12 million rate increase designed to recover a recently completed treatment upgrade. The regulator delays the decision for 1 year. Customers continue receiving water, the new plant continues operating, and the associated debt continues charging interest. But revenue remains at $100 million. Cash operating costs stay at $56 million because the system cannot switch off essential functions. EBITDA falls to $44 million. After $23 million of depreciation and $17 million of interest, only $4 million remains before taxes and other items. Net income approaches $2 million. Cash available after adding back depreciation is now about $25 million, while the capital program still requires $40 million. The funding gap expands from $6 million to roughly $15 million. Nothing dramatic happened to demand. No contamination crisis occurred. The utility did not lose its service territory. One regulatory timing decision nearly erased accounting profit and more than doubled the external funding need. That is, regulatory lag in financial form. A well-capitalized owner can bridge the delay. A highly leveraged owner may need expensive debt, an emergency equity injection, or a reduction in discretionary projects. Cutting capital can protect short-term liquidity, but postponed work may increase leaks, failures, and future costs. The decision that helps the balance sheet this year can weaken the physical network 5 years later. The future will make this balance harder. EPA's drinking water infrastructure assessment shows how much replacement is already required, and new rules are adding urgency. The lead and copper rule, improvements require water systems to identify and replace lead and certain galvanized service lines under their control within 10 years, subject to limited exceptions. That means utilities must locate buried materials, obtain access, coordinate construction, communicate with customers, and fund replacement programs on a defined timetable. Climate pressure adds a second challenge. Drought can reduce source availability and encourage conservation, lowering sales just as utilities need new reservoirs, interconnections, recycling systems, or deeper wells. Floods can damage treatment assets and contaminate sources. Wildfires can affect watersheds. Extreme cold can break mains. Resilience requires more capital before the next emergency proves why it was necessary. Technology will improve parts of the model. Smart meters can identify unusual usage. Pressure sensors can reveal leaks. Automated treatment controls can improve efficiency. Predictive maintenance can direct crews toward the highest risk assets. The same technology creates cybersecurity exposure. A modern water utility is not only pipes and pumps, it is also a network of connected control systems, customer data, remote sensors, billing platforms, and operational software. Protecting those systems becomes another permanent cost of reliability. So is a water utility a good business? The answer depends on the price paid, the condition of the assets, the regulatory framework, the allowed capital structure, the cost of financing, customer affordability management, quality, and the amount of investment waiting below ground. A protected territory can be valuable. Stable demand can support long-term financing. Necessary infrastructure spending can expand the rate base for decades. Those strengths do not remove risk, they relocate it. Demand risk is lower than in many industries, but regulatory risk is higher. Competition is limited, but political scrutiny is constant. Revenue is stable, but free cash flow can remain negative during heavy investment. The asset life is long, but the replacement obligation never ends. Customers cannot easily leave, yet the owner cannot freely charge what the service costs. None of this makes a water utility automatically attractive or unattractive. Figures change with location, regulation, financing water supply asset condition, and new legal requirements. This is an explanation of the machine and its historical cases, not personalized financial, legal, accounting, or investment advice. At the beginning, owning a water utility looked like owning pipes that sell an essential product to customers who cannot switch. What you are really buying is a permanent public obligation financed with private or public capital, supervised by regulators and buried beneath every street in the service territory. You thought you were buying water. You were buying reliability regulation and a promise that can never be turned off.